Dabur India Limited case study. I will share today fundamental analysis, technical analysis, and what price it should be buy or what is the target of Dabur India Limited. So start with about the company. Dabur India Limited is one of the leading fast-moving consumer goods FMCG player dealing in consumer care and food products. The company has a rich Ayurvedic heritage of almost 136 years and is the fourth largest FMCG company in India. Growth, sales growth. So, sales growth in first year 20 revenue grew by 2%. On account of COVID-19, both the geographical witness loss of sales and hence the growth was impacted. In 9 months FY21, the revenue grew by 5.7. In FY20, the EBITDA grew by 3% to 1,792 crore, which was the mostly led by revenue growth. In 9 months FY21, the EBITDA grew by 8.3% to 1,560 crore, which was mostly added due to lower other expenses during the period. The management has indicated that it would take necessary steps like cost optimization, reduction in consumer product promotion and advertising expenses in order to keep the prices of all products under control. Now, a profit after tax growth. The PAT was flat at rupees 1,448 crore in FY20, which was impacted partially due to an exceptional charge worth of 100 crore, which was on account of impairment of treasury investments in DHFL and Reliance Home Finance due to downgrade and failed repayment. In 9 months FY21, the profit after tax was higher by 13% to 1,318 crore, mainly added due to low base effect. The company would continue to strengthen and leverage the power brands, expand the distribution network, digitize the operations, optimize costs, and build organizational capabilities for sustainable and profitable future growth. Profitably EBITDA margin. From FY16, the company had optimized its advertisement cost, which led to expansion of its margin to 22% from 18% in FY15. The EBITDA margin has been flat over the past 2 years at around 21.7%. In 9 months FY21, the company was able to maintain its margin at 21.6%, which was added mainly due to savings in other expenses and favorable product mix during the period. Profit after tax margin. In FY20, the PAT margin were lower at 14.9%, impacted due to exceptional charge during the year. In 9 months FY21, the PAT margin were higher at 18.2%, added mainly due to lower base effect. Profitably ROCE in next slide. Similar, Dabur had a healthy average ROCE of 31.3% over the past 9 years. However, over the past 4 years, the ROCE has come down from 34.5% in FY16 to 26.4% in FY20. The company has been incurring higher capital investments in both brownfield and greenfield projects, along with the new factory which is currently being built in Assam over the past few years. These have had an impact on the company ROC over the past year. ROE, return on equity. Similar to the ROCE, the company has had a healthy average ROE of 34% over the past 9 years. However, that has been continuously falling over the years on account of falling net profit growth. Efficiency, cash flows. Dabur has a very healthy and strong cash flow from operations profile over the past 9 years. In FY20, the CFO was 8% higher to 1,614 crore. Cash flow from investing was an outflow of 517 crore, which was on account of higher capex worth 377 crore as well as higher investments made during the period. Cash flow from financing activities outflows were lower at 1043 crore due to lower dividend payment in FY20. Dabur has been leveraging the new age channels like e-commerce, cash and carry, and modern trade, which is enabling them to make learner operations, thus aiding the cash flows of the company. Working capital cycle. The working capital cycle of the company has improved significantly over the past 9 years. Initially, the working capital used to be tied up for around 35 days, and currently in FY20 it has come down to just 2 days. This has been mainly due to extended payable days along with a control over receivable and inventory days by prudent collection system driven by online payments and selective incentives for yearly payments along with plant stock piled up over these days. Efficiency, free cash flow. Dabur has had a healthy and positive FCF, free cash flow per share over the years. In FY20, the FCF per share was lower at rupees 6.75 per share due to higher net capex during the period. The capex was incurred on developing the domestic as well as the overseas manufacturing facilities over the past 5 years. The company has allocated 3% to 5% of revenues on its capex activities. The company intends to keep some portion of the cash flows in order to fund future capex programs into newer projects, expansion of capacities, rejuvenation or modernization, as well as acquisition of brands. Asset turnover ratio. Dabur has had a stable asset turnover ratio over the past 5 years at around 1.09. The sales growth during the period FY16 to FY17 was impacted due to factors such as demonetization, currency devaluation, below average rainfall impacting the rural sector, and hence slowdown in the FMCG industry, along with other headwinds in the international market such as geopolitical issues and currency volatility. Lower sales growth rate from 16 to 18 and on other hand consistent increase in total assets impacted the asset turnover ratio. Debt to equity ratio. Dabur has a low debt equity ratio which has reduced from 0.72 in FY12 to 0.08 in FY20. In first year 20, the Company did not have any long-term borrowing. Rupees 163 crore worth of non-current liabilities are related to the long-term maturities of lease liabilities, remaining short-term borrowing formed as part of the working capital loans. And next slide, solvency interest coverage ratio. The interest coverage ratio of Dabur has also been fairly stable over the past 5 years. Overall, the EBIT is healthy enough to cover up the interest obligations comfortably. Current ratio. Dabur had a comfortable current ratio over the years. In FY20, the current ratio rose significantly to 1.98 from 1.35 in FY19, led by higher short-term investments into non-convertible debentures and liquid mutual funds. Majority of current liabilities from trade payable of company, and on the other hand inventories forms majority of the current assets of the company. PE ratio. At the current market price of 524.55, Dabur is trading at P of 58.07 based on TTM Best EPS. The company is focused to improve its presence in the Ayurvedic segment, which would help to garner higher margins and hence improve the profitability of the company. However, any threat to the market share in the healthcare segment due to the competition would be key risk to the company valuation. Dividend yield. For the year FY20, the company has declared an equity dividend of 300 amounting to rupees 3 per share at the current share price of 524.55 per share. The dividend yield comes at 0.57%. Over the past 5 years, the company has had a dividend payout of 43% with a substantially high payout of 81% in FY18. Technical analysis. Valuation. Dabur India has been in a steady uptrend since the last few years. The stock had been consolidated between 360 to 480 from the last 3 years. The trading and delivery volume activities has increased significantly since March 2020, and the stock has been able to sustain above 500. So I would suggest investors can accumulate the stock between 480 and 520. On the upside, move beyond 550 might see the stocks heading towards 600. So target price is Dabur is 600. Quality management. So the management of Dabur had shown nimble footprint and agility during the tough pandemic period by responsibility to the changing dynamics in the marketplace with a more streamlined portfolio and refreshed positioning to meet the emerging needs of the customers. The management is keen to enhance the popularity of Ayurveda and make it mainstream, which includes launch of contemporary formats, enhanced distribution and visibility, and promotion on digital media. The power brand strategy has been one of the key pillars of growth. Dabur is putting disproportionate investments behind these brands to improve visibility, enhance distributions, and drive innovation. Stakeholding pattern. The promoter group holds 67.87% stake in the company. FII shareholding increased to 18.52% while DII shareholding decreased to 5.93% in December 2020. Non-institutional shareholding also increased to 7.67%. Top public shareholding: First State Investments ICVC 1.34%, ICICI Prudential Life Insurance 1.18%, Qualified Institutional Buyer 0.96%. Competitive landscape: Dabur has been facing competition from a very long time, with new players entering the market. Innovation, product launches, high distribution reach, and brand awareness are a few of the areas that the company has been continuously working on. Dabur specializes in the Ayurvedic product, which caters to all age groups. Upon the entry of Patanjali, the company benefited due to increased awareness of Ayurvedic products, and consumers who tried competitors' products came back to Dabur as they understood the difference in quality. Going forward, the company would continue to work on its core portfolio, expand the distribution network, and strengthen the market share. Thank you so much. I hope this case study you analyzed, and based on you can take your own decision. And this document and the process of identifying the potential of company has been produced only for learning process, since equity involves individual judgments, and this analysis should be used only for learning enhancement and cannot be considered to be recommendation on any stock or sector. So this knowledge has limited understanding, and we all are learning the art and science behind this. If you like this video, then please share and subscribe my channel. Thank you so much.